On the latest Masters in Business podcast, an amazing conversation. I sit down with Jurrien Timmer. He's the director of global macro at Fidelity. They run about $16 trillion in client assets. They touch about 50 million separate clients. What an amazing conversation. Jurrien has been started out in fixed income before he became a market technician. Now global macro is his beat, which means he covers everything: U.S., overseas, equity, bonds, commodities, economic data. I thought this conversation was fascinating, and I think you will also. What a depth and breadth of knowledge. With no further ado, my conversation with Fidelity's Jurrien Timmer. Welcome to Bloomberg.
Thank you very much, Barry.
I've been looking forward to this. I've been consuming your stuff for, it feels like, forever. I'm a big fan of what you do. But before we get to your work at Fidelity for the past 3 decades, let's talk a little bit about your background. You get a bachelor's in finance from Babson College. What was the original career plan?
Well, so I was born and raised on the island of Aruba in 1962, when Aruba was still very small and sheltered. And as a Dutch citizen, now also an American citizen, but generally the Dutch kids would go to Holland to go to higher education. But I was in love with the American culture. I met many tourists on the beach, and so I wanted to go to the States and do the American thing. And then my father, who was an importer of construction materials, etc., he had contacts in Boston. They said, okay, well, you should send your kid to Babson because it's small. He won't be overwhelmed as an international student. And I've always wanted to be an architect, but then in the last year before finishing high school, I'm like, I don't think I'm good enough to be an architect, so let me do business. And I figured, there's always something you can do with a business degree. And so I studied finance with a minor in investments. And then, I graduated with no work permit, right? So I was in that place where you need to have, obviously, a work permit. So back then, I don't know if it's still the case, but back then you got 1 year practical training visa, and then you had to go, get a real visa. And so I took literally the only job that was offered to me in the United States. So I applied to every Dutch company. I figured at least they'll have maybe some sentimental reasons to hire a Dutch person. I could have worked in Holland, of course, but I wanted to be in the States. So the Dutch bank ABN, which later became ABN AMRO, hired me. I went to New York into their corporate banking credit program, in which I had zero interest. But it's like, this is the job.
No pun intended, right? But you eventually become pretty senior in the fixed income group at ABN.
Yeah, so I was very lucky. And again, it's sort of, you take the job that's offered to you and you make the best of it. You play the hand that's dealt. And literally within a few months, ABN set up a capital markets group because, we were the primary dealer in New York together with LaSalle National Bank in Chicago for the HQ in Amsterdam, which, of course, was one of the world's largest banks at the time and a very large treasury book. And so I was the person who would execute the trades for HQ. So I became a client of like Solomon Brothers and Smith Barney and Goldman Sachs, et cetera. And so I got into the Wall Street game and I learned everything about fixed income. And to this day, I'm, if you're either a stock market person or a global macro person, having a foundation in fixed income is so important.
It's so true you say that. Some of my favorite stock analysts began as bond analysts because they're concerned about return of capital, not return on capital, and it focuses them very much on staying away from the speculative nonsense and it's been very consistent over the years. I have a list of some favorite people in that space. So you start out in fixed income. When did technical analysis and becoming a CMT arise in your journey?
So I was at ABN AMRO in New York for 10 years. And so I'm there executing trades, learning about the markets, watching the Teller 8 and the Bloombergs were still, there were the quad screens with the amber.
Right.
And I've always been a visual person. And so I started gravitating towards charts, and charts are kind of the mainstay of what I do even now, 40 years later.
40 years later,
yeah,
that's crazy.
And I like to write. I think I get that from my dad, who's a great writer. And so I always had this kind of urge to put pen to paper and to show charts. And so I just started writing a newsletter for the people in my universe at the time. And it would be like charts from CQG, cut out, taped onto a typed report, and then faxed to people. Like that's what the technology was back then. And so it was. So that's how it started. And then I ended up, getting the chartered market technician. Although that may have been during the Fidelity years.
So how did you go from ABN AMRO to Fidelity? When was that?
So the culture at ABN AMRO, not to spill any beans, but this was a long time
30
ago. 30 years ago. I didn't like where it was going. So we ABN had a bank in Chicago, and they saw what a profit center in New York was. So they wanted me to work for them, become a commission salesman, and I'm like, it's not what I do. And just coincidentally at that time, Fidelity came looking around, looking for the most obscure job in the world, a fixed income technical analyst.
Right.
I mean, talk about a narrow field, right?
Very specific.
So that was in 1994. Around that time, I was kind of looking around, and I had two major career highlights within 6 months of each other, because in '94, I was approached by Paul Tudor Jones's company.
Oh, really?
And so I had a meeting with Paul in his office downtown New York with this giant Telerate on the screen, and we were looking at the bond chart, '94, the bear market.
Right, and he very famously had called the '87 crash before.
And he was like, do you think that's a fourth wave? And we were having that conversation. That was great. And then, I was approached by Fidelity, and I ended up going with Fidelity. But the last interview of that process was with Ned Johnson.
Oh, really?
And so I spent
the founder.
I spent an hour with him in his office talking about markets, because I was hired to go into the chart room, and at Fidelity, nobody got into the chart room without Ned's blessing, right?
And back then, were they still doing charts by hand?
Yep.
Amazing.
And so that's how the Fidelity career started. And it was interesting because this is now early '95, and of course '94 was that bear market. We had the so-called tequila crisis in Mexico, and so the new mandate from upstairs in '95 was, we're not making any duration bets. You just stick to your bottom up, you look at credits. And I'm coming in there as a technician, and what am I supposed to do now? There really is nothing for me to do. And so at that point, I kind of reinvented myself and became multi-asset, and I went to the equity side. And anyway, so that was the start.
When you say multi-asset, I think you're the only person in all of finance with the title Director of Global Macro. Global means around the world. Macro means 30,000-foot view.
Yep.
Is everything out there in your jurisdiction?
Pretty much. So I don't do security selection. We have armies of very talented
But
analysts.
you do stocks, bonds, alts, crypto, commodities, gold, you name it.
Everything, but it's top down.
As well as economic data,
Yes.
interest rates,
Yes.
employment, et cetera.
And that's how I transitioned from being a technical strategist to being more kind of multidisciplinary, because I quickly learned at Fidelity, as I was roaming the halls, pitching ideas to portfolio managers who generally are fundamentally oriented, right? It's like I'm speaking a different language, right? So Fidelity's always had a lot of technical analysts and the chart room, but I had to reinvent myself again and pivot towards at least speaking their language. And a chart is a chart, right? It can just be a bar chart of the S&P, or it could be of the PE ratio or earnings or monetary policy. So I figured a chart's a chart. I'm going to weave a broader approach to this, and that's where kind of I came up with the title.
So whenever I see a technician and a fundamental analyst having a discussion, somewhere along the line, someone says, look, I'm a technical analyst. I'm just telling you what's going on in the battle between supply and demand. It's up to you to create a narrative around that. You tell us what's going on fundamentally. I don't know, but I could tell you who's winning, the buyers or the sellers.
Yeah, so the fundamentals tell you kind of the why, maybe the what and the why, and the technicals tell you kind of the when and the how much. It helps give you conviction. And generally speaking, we use technical analysis like our equity PMs do. Like they're obviously going to have an idea about a company and what their long-term prospects are. But then our technical analysts will say, okay, well, you've rated this stock a 1, meaning strong buy, but the chart looks like hell. Like you should be aware that what's happening is not the same as what should be happening, and maybe it takes time, but it's like it's a second opinion which can be very helpful, and the other way around as well. Like a chart looks amazing, but it gets a really poor fundamental ranking. And we also have a quantitative team that does a quant overlay as well.
So we talked about global macro. I'm curious. You're a Dutch citizen originally, born and raised in Aruba, now a citizen of the U.S. for the past 25 years. How does that international upbringing affect how you see the entire world of assets?
Yeah, it's a great question. I do think that I've been privileged to grow up in a very diverse environment. Like if you look at old high school pictures, I'm like maybe one of 2 white kids in there. Everyone else is different shades of, brown. You have all kinds of ethnic sort of diversity.
What is the name for people from Aruba?
Well, they're Arubans.
Arubans, is that all it is?
Yeah. But so very, very diverse, and so I think, and also just going to different countries and learning different cultures or being exposed to them, I think it's helped me. Like I view myself sort of as a global citizen.
Well, you're a globetrotter. You're in the U.S. You were in California. You're in New York, Boston. You going to where? What's your next few stops? London.
I'm flying to London on Saturday. I'll be in Geneva after that, and then.
We were just in Lake Geneva a year ago. Spectacular.
Yeah. And then actually we're going to Holland because my parents they live in The Hague. They're celebrating their 70th wedding anniversary.
Wow, that's
amazing. They're 91 and 97. Wow. So we got 3 generations of Timmer descending on The Hague in about a week and a half. So.
Talking about global trials, I'm in Amsterdam for a week 2 years ago. I feel like, look how sophisticated I am. I was just a tourist for 7 days. But one of my favorite cities.
Yeah, and I think I feel at home in almost any place
really
in the world, and when it's hard to understand what someone says because the English is not their first language, you can kind of like. You figure it out because you're just kind of used to this, this environment where everyone's coming from different places, and like even now, like I run, and this is totally separate topic, but I run a food camp at Burning Man, and it's a very global camp. We have 90 people. We all cook meals that we gift away to the artists there, but we have like 30 Brazilians, and we have like French and Swiss and Mexican people, and obviously Americans, and that like it's easy to do because you're just used to having all these different cultures in the same space. So
I'm kind of fascinated by the new. I don't love the earbuds; they're not comfortable in my ear, but the new AI-enabled instant translation. That is Star Trek next level.
It's very cool.
Futuristic. I can see that saying, "Oh, you want to go to Japan or Korea or China? Here you go. Knock yourself out." Yep. That sort of technological innovation is. That turns that into a must-have technology. Yeah, for sure. How many languages do you speak? I speak, obviously, Dutch is my native language. English, I used to be totally fluent in Spanish, but I've kind of lost that. And then, of course, there's the world language called Papiamento, which is what they speak in Aruba, which is essentially kind of a Spanish-Portuguese blend. But if you don't know a word, you can just say it in Dutch or English, and and it's completely acceptable. Really fascinating. So we were talking about what a globetrotter you are. Let's trot around the world and talk about various asset classes. Since you began your career with bonds, let's start with bonds. How do you see what's been going on with Treasury yields, anticipating not only the 25 basis cut point we had in September, but perhaps a couple more this year and next.
Yeah, so Treasury yields, such an interesting market right now. We've been stuck sort of between 4 and 5%.
For a while.
For a while. And when we go above 4.5, it's like nothing good happens. Like the old Fed model from the Greenspan days comes lurking back, and it starts to wobble the stock market because the bond yield and the equity yield are about the same right now. And so that takes you back to the 80s and mid 90s and even the 70s and 60s, where bonds to stocks were positively correlated instead of negatively correlated. That happened. That began during the Great Moderation era, late 90s until COVID, basically. And so then in 2022, of course, the correlation flipped back to positive. It was rising yields that caused the problem in the stock market, and so there's a whole broader conversation about the 60-40, but just dealing with treasuries right now. So as you get close to 5, it really starts to freak the stock market out, but also the bond buyers start to emerge because there's value, right? I mean, real rates are positive.
5% yield over 2.5% inflation. You're actually
the
making
income is
some money.
back into fixed income, right? But down at 4, when you have a growth scare, kind of like, I mean, I wouldn't say it's a growth scare, but the jobs market.
There's some nervousness and some, I hate the word uncertainty, but there's a lack of clarity as to how all these things, tariffs, yield, FOMC plays out.
Yeah. So at 4, generally, I would be a better seller than a buyer. But this question of, fiscal dominance, clearly the administration wants to grow out of the debt. I think that's the very overt plan, if you listen to Scott Bessent or even
they're
the president.
pretty explicit about it.
And so they're trying to goose the economy and outrun the debt because everyone knows you can't really cut the debt very much because too much of the budget is not discretionary. And so that's the plan. And I think it's a good plan because what are the alternatives, right?
Raising taxes and cutting spending, which we know what the odds of that happening are.
But running kind of that fiscal train means deficit spending, or at least that's part of it. And that means more supply, and that could mean higher term premia for long treasuries. And we've seen that, right? The term premium during the QE financial repression days was like minus 150, which makes no sense, right? A risk premium should always be positive. And now it's plus 60, plus 70. But historically, it's been plus 150 or even more. And so if the term premium mean reverts back to a normal level, positive level, because deficit spending and debt levels are rising, you could easily see a 5 handle on treasuries. And a 5 handle on treasuries are not going to sit well with equities. Like the equity market can go up, earnings can drive the bus, but the PE gets under pressure because the risk-free asset is now competing with the risky asset, and they're offering the same yield.
So quick question on that. In the 2010s, or at least towards the end of the 2010s, we had an inverted yield curve for a while. What's the impact of that on that term premium or lack thereof?
Yeah, so we had that very inverted yield curve. Obviously, it shouted recession, and it didn't happen. And I think the reason, in hindsight, was that the economy is just less interest rate sensitive than it used to be, right? So everyone refied their mortgage in 2020 and 21 at sub 3%. That's also why the housing market is frozen.
Right.
But also, if you look at the big banks, right, why is a yield curve inversion typically bad? Is because banks' net interest margins goes upside down, right? They borrow short, lend long. And so banks stop lending, and you get a credit crunch, and you get a recession. But in this case, the large banks, if you notice, your deposit rate at the large mega center banks has not really gone up commensurate with the yield on money market funds,
That's right?
So that deposit rate went up to 0.5% and is now coming back down again. So for a large bank, the yield curve not only was never inverted, it was extremely steep. 0.5% funding, right? If you're funding your loans on deposits and you're paying 0.5% on those deposits, and you can lend at 7 or 8%, you'll do that all day long.
And so, yet, at the same time, we've watched money markets go 5 trillion, 6 trillion, 7 trillion. It's become so easy with your app to move money from, hey, I'm going from Chase to Schwab, I'm going from Citi to Fidelity, where I'm getting real yield. I wonder how much technology plays a role in people It used to be a pain in the neck. Oh, I'm getting 0.25% in my checking account, but do I really want to write a check and mail it out and wait for the...
Yeah. So you leave money at the bank for convenience. You know, you got bills to pay. But if you have extra cash, you're buying a CD or money market fund or buying T-bills or what have you. And it's a lot easier than it used to be. And so now you got $7 trillion in money market funds, which a lot of people actually think is money waiting to be invested in the stock market. But I don't think there's really a signal there, because I think that money came out of the banks and probably will go back to the banks at some point.
Some people have said, hey, as soon as the Fed starts cutting rates, it'll A, make the cost of borrowing cheaper for corporate America as well as American households, and B, is going to scare some of that money away and it's got nowhere to go but equity. Fair narrative or kind of a lot of wishful thinking?
It could be a combination of both. But if you typically look at when money market fund assets swell, like it did during the pandemic, it's money coming out of the stock market seeking a safe haven. And then when the stock market recovers, the money goes back in the stock market. That's not the pattern this year. The money came out of the banks, in part because of like the Silicon Valley debacle a few years ago.
But also 500 basis points of rate hikes in 2022.
So money markets went from 0 to 5.5. And
suddenly attractive.
And deposits went from 0 to half. You know, so money markets yielded 10x the bank deposit. And so some of that may go to the stock market, but it didn't come from the stock market. Let me put it that way.
So you noted something really interesting. I remember you wrote in 2022, bonds went from being a port in the storm to the storm itself.
Yes.
So normally we think of money leaving equity and going in the safe harbor of money markets. Were we seeing money exiting bonds and going to money markets? Is that what happened? Was it a duration play?
From among sort of the typical investors, we have not really seen an exodus at all. And I think part of that is just the demographics of, you know, the baby boom solving for income more so than growth. So when you look at fund flows into fixed income, they've remained strong. And they were strong at 1%, and they're strong at 4%. So I think that is more of a structural trend than playing the markets, if you will.
Right.
Like, I think the average investor is not looking at, okay, well, real rates are now positive, so let me do this. But they're solving for outcomes. They're buying solutions-based funds, like our target date will have certain amount of fixed income.
Which have just attracted so much money in 401ks over the past 20 years. It's amazing. So let's talk a little bit about equities. I keep hearing people complain about valuations, but if you stayed out of equities due to elevated valuation, you missed most of this run from the 2013 breakout. Yes.
So the market obviously is very bifurcated. We got the Mag 7. The cap-weighted PE is, 23, 24. The equal-weighted PE is 18. So there's a very large gap there. Mm-hmm. If you look back at the mid to late 90s, which is a kind of an analogous period to today, right? We had the 94 stealth bear market when Greenspan raised rates 300 basis points. Then he gave back 75, and we had a huge rally. And it was also the start of the internet boom, the Netscape IPO, I think it was like in 96.
Yep.
So the post-2022 period, very analogous to post-1994. Soft landing, ease off the brakes, markets rip. And then the post-98 long-term capital, that 22% decline, very robust recovery, and then Greenspan eases 3 times into that recovery. We're seeing the same thing now. We had a 21% tariff tantrum, no recession, the kind of the administration backed off. Very, very strong, one of the strongest ever recoveries from a 20% decline other than 1998. And then now Powell's easing into that. And so, but the point is that period saw almost nonstop multiple expansion. And that's what we've seen since 2022. And, PEs are... They are strong predictors of long-term return. So if you take a 10-year CAPE ratio and you regress that against 10-year forward returns, you see a very high, it explains the forward returns very well. But over the near term, a high PE has very little to say about the next year or two. And this is because the market tends to be in a rising trend. Momentum begets momentum, and that's what we're in. So it's a tough game to time on the mean reversion of PEs.
Valuation, right.
Even though we know that historically it's between 10 and 30 and it does mean revert, but when the mean reversion starts and from what level is very, very difficult to do, especially during secular trends, which I think we're very clearly in.
So many different places to go with this. I have a dozen questions. Maybe we'll go a little long the segment and delve deeper into equities. I love the concept of a secular bull market as opposed to a cyclical. But I think a lot of people don't really understand the difference. Give us your definition of what is a secular bull market, when this one began, and why.
Yeah, so we have the market cycle, which is generally driven by the business cycle. So you have a recession and you have the early cycle recovery where things get less bad. And of course, the market is always anticipating that, right? The market's always in price discovery. And this is why at bottoms, price will lead earnings, which is why the PE always goes up in the first year of a bull market, like it always does. And it doesn't make sense on the surface. People are like, oh, this can't be real. It's all PE driven. Where are the earnings? Well, the market's just front-running the earnings. Yeah.
Right.
But then there are the secular trends. And, if you go back 100 years, you can see them, you can spot them very easily because the market has a kind of central trend line, plus 10% nominal, plus 7, 6 3/4 real. And if you run a regression trend line against the total real return of the S&P or some basket of stocks going back 150 years, it's like perfect. And then you have the pendulum swinging above it and below it. So you have
very noisy, but still the overall trend is being maintained.
But you have these super cycles where you're outperforming the trend line. So the 80s and 90s was one of those. So instead of a 10% return, we got 18% returns for like 18 years. The 50s and 60s after World War II.
Right.
The 20s, that was a truncated one, but from 20 to 29, boy, did that thing go. And since 09 is where I put it. Other technicians generally disagree with me. They think it was 2013.
Right.
When you look at the CAPE model, you look at deviation from trend, you look at the slope of those early trend lines, for me it's 09, which puts it at 16. And of course, and then you have the secular bear markets, right? So the 2000s was one, the 1970s, very famous, of course, 1930s. Doesn't mean the market necessarily goes down, but it's underperforming that 10% trend line. And generally, in real terms, it's probably going down. And so that's kind of how I define the secular trend.
So we are in agreement on so much stuff. I'm going to circle back to 09 and push back a little bit. But you mentioned that first year you get a PE spike as the market anticipates improving earnings. One of the things that's kind of fascinating is to see how much of a bull market's gains are attributable to not improving fundamentals, but multiple expansion. From 82 to 2000, what was it, 3/4 of the gains were multiple expansion? How much of that is psychology and how much of that is just people getting on board late in as the market rallies?
It's both, but yeah, for instance, in 82, the PE was like 7.
Right.
And in 2000...
And what was the yield in 82?
It is double digits, almost 20%.
A lot of competition.
And then in 2000, yes, exactly. And in 2000, the PE was 35. Using operating earnings, that was the forward PE, actually. The trailing PE was like 45.
Wow.
So that's a hell of a pendulum swing.
Yeah.
And, obviously... 1982, inflation was very high. They had the malaise in the economy. Bonds were very competitive. Nobody wanted to pay for earnings.
The death of equities was just a few years earlier on in Business Week.
Death of equities, yes, for sure. And then people become more comfortable, and then they go from comfortable to confident, and then it's like, yeah, I'm going to pay 20 or 25 times these earnings, and then of course, then you have the growth. The growth stocks, so the late 90s obviously were I used to call them the Janus 20. There was a fund that would just own the most stocks. And so
I remember the Ryan Net fund around that
exactly.
time.
And of course right now it's the Mag 7, formerly known as the FANGs. And those are secular growers, right? And there's a theme, right? It was internet back then, it's AI now. And people get onto the bandwagon and it's like, yeah, I'll pay 35 times earnings for a company that is in this space and is going to grow their earnings in a secular way, not a cyclical way.
Mm-hmm.
And so it's totally plausible and understandable, but at the end, it goes too far, and I don't think we're anywhere close to that. But then you start looking for signs of froth. But that's the pendulum swing.
So let's talk about '09 and why so many of your technical brethrens dated to 2013, which was when all of the major indices broke out over their prior trading range. So the pushback I hear to '09 is, well, that's like dating the 82 to 2000 bull market to the lows in 73, 74, and all you're doing over that period is recovering the sell-off. 2013, what we were down 56, 57% from October '07 to March '09, and then to get back to where you were in '07, it took till 2013.
Yeah.
So why '09 as opposed to 13?
It's totally a legit argument, but I would say a couple of things. One is this is not an exact science, right? There's only been 2 or 3 or 4 secular bull markets, right?
Small data set.
Small data set. It's not a quant model. You have to look at the chart, at the slope. So I date the secular bull market from the 50s. I date at 49. Even though 49 was not the low, right? The low was
46, 44, something like that.
But in 49, something changed, and the slope started to, like the market found itself, and that trajectory started to really compound at double digits, and you broke out of that big shelf that was really from 29 all the way to 49. 70s, the low was, of course, in 74, October 74, after 48% bear market. We had some other little cycles, but then in 82, it took off. There was a change in the fundamentals. Volcker broke inflation, and then you look at the case. So then I get verification from the fundamentals. So I look at the charts, and yes, I see the argument, and I agreed. It's a good point. But in '09, the market just went straight up after a decade of sideways. In 82, the market went straight up after a decade of sideways.
I see.
In 49, same thing. Whether the low was in or not. And of course, in real terms, the 82 low was below the 74 low. So
because of inflation, you really fell tremendously in the 70s.
So I want to get second opinions from the real chart and from the fundamentals. So the CAPE model, again, where you compare the 10-year PE to the 10-year forward return, looks very similar at the '09 and not similar at the 13 when the market already had a lot of momentum. And then the other thing I look at, again, that 150-year regression trend line of the real S&P.
150 years.
Yeah. And so at secular peaks, the market is about 100% above the trend line, and at secular troughs, it's about 50% below. So that point was in '09. It was not in 13. So I look at like the weight of the evidence from a multitude of indicators. And again, it's not an exact science.
Right.
I'm not saying I'm right, they're wrong. But that's, for me, that's where I get.
But you've been a whole lot more right than wrong than many other people.
And it's interesting. So in '09, I was actually running a fund back then, a kind of a global macro fund. And I was like, the market was so depressed, right? So remember March of '09.
Sure, of course.
And I'm like, I want to be long, but what if I'm wrong? And I'm like, at this point, if I'm wrong.
So what? You're already down 50, cut in half.
Well, but at that point, the whole system is going to collapse. Right. So it's like, why not bet at that point? And so. Yeah.
When is down more than 50% in U.S. markets not a great entry point?
Yeah, exactly.
I mean, that's one thing. But I have to ask you a question about '09. So I was looking through some of my old notes as I was preparing for this, and I'm curious as to your thoughts on some of the behavioral aspects, including sentiment and bull-bear ratios. I wrote something up in October '09 calling that recovery the most hated bull market in market history. Markets went straight up. Everybody was miserable. it's a head fake, it's a false breakout, this is all going to be a disaster. And if you listen to those people, you left a ton of money on the table.
Yeah.
What's your thought on that extreme sentiment in one direction or the other, and just what it means when everybody hates a particular asset class?
It's obviously an opportunity because that means that everyone is not on the same side of the boat, right? And what I was,
or they're all on the wrong side of the boat.
But before I answer the rest of that, what I was going to say earlier was, when you run the regression of the 09 to present S&P, either in real or nominal terms, and you run the same regression from 82 to 2000, from 49 to 68, it's exactly the same slope. And so if in 09 I got bullish, and in 13 I'm like, yeah, now we've taken out the high, so now we can say this bull market is confirmed. So the 13 for me is not the start, but it's confirmation. But if I had looked at nothing else for the next 12 years, today I would be within 10% of that slope having materialized. And so, again, you're never going to do that on a secular chart. You want to have weight of the evidence, but it shows you how powerful that context can be to just look at those different time frames and see where they are, because it'll keep you on the right side of the market.
So last question on equities. Given the 49 to 66 rally, the 82 to 2000, and then the 09 forward, how much legs does this secular bull market have? Can this go another 5, 6, 7 years? And the other related question is, how much of a reset does that giant fiscal stimulus of 20, 21, 22 build into markets?
It's a great question. And so on the surface of it, we're 16 years in. The last two were 18 years. But again, sample size of 2. Like right. you can't go with that, right? But the CAPE model, again, which has been a very good long-term model in terms of the 10-year CAGR for the market, suggests that the PE, the growth rate in the PE peaked in 19 for obvious reasons, because it's a 10-year model. So 09 rolls off, and then you have that peak. And we've been holding steady at around 14, 15% 10-year CAGRs. That actually has another peak in about like 2026, 7, 8. My guess is that acceleration will be an AI bubble, or it could be where it's just like, the AI boom, the Mag 7, like all of a sudden everyone's buying companies with no earnings because they're promising to be the next killer app and that sort of thing.
TheNextPets.com.
Yes. And my guess is that if we are heading into a fiscally dominant era, or we're in it already, so we had $5 trillion of helicopter money in 2020, we now have another $5 trillion fiscal bill. If the next Fed, post-Powell, is going to be just more dovish than the economics suggest in order to help fund that debt, then you could see inflation, be structurally higher than 2%, maybe 3 to 4. And if the 10-year yield at that point goes to a 5 handle because the term premium is back, you can easily see a scenario where in a few years, again, that Fed model principle of rising yields bringing down the PE is going to be the thing that flattens that secular slope. That doesn't mean like a 2000s like bear market. It doesn't have to mean that. But it could just be a flattening. Instead of running at 2x the 10-year rate of change, maybe you're at half x or something like that.
So generally speaking, when you see an elevated CAPE, it's not a sell signal. It's really a signal, lower your future return expectations. Things are going to be a little less easy sledding.
Yes, I think the next 10 years will be less robust than the last, but it doesn't mean they have to be negative at all.
You mentioned the 80s into the 90s and the post-World War II era. It's kind of fascinating to look at rolling 15-year periods. The 15 years following 09 is the third best 15-year period in history. It's really amazing.
Yep.
So let's talk a little bit about the current environment. You look at more than just stocks and bonds. You look at a lot of economic data as well and chart that. So how do you think where we are in the current economic cycle? How do you describe our location in the business cycle?
So generally speaking, the economy remains pretty solid. People are employed. Their wages are exceeding the inflation rate at this point. Debt levels are not high, at least as a percent of GDP, right? So the household debt to GDP ratio peaked during the financial crisis in 2008.
It's pretty modest and has been.
Yeah, it was 100% of GDP. It's now 70. So there's a debt issue on the government's balance sheet, but not in the household or even the corporate balance sheet.
Even the government side, isn't our debt to GDP ratio like half of Japan, something like that?
So about 120% if it's just the federal debt. If you add all other debt, it's about 250. But it's comparable to other regions, but certainly Japan gets the prize and China as well, just in terms of the growth rate of the debt.
China, not total, but
No.
China's been growing debt, and the Chinese provinces have been growing debt as well.
Yeah, and the Chinese numbers, of course, are can be a little vague because the federal debt in China is not high, but they have the four big policy banks that are essentially providing liquidity, and so you have to add that. And so China and Japan are the worst offenders. The U.S. is on par with most kind of European and other countries. But so anyway, so the economy looks pretty good. But one of the things that COVID did was it sort of upended a lot of the things we think about when we look at the economic cycle, at the business cycle. So, of course, we know what happened. The economy froze. People got laid off. And then, at least in the U.S., the economy came back really faster than in other places. And the labor wasn't there, right? Baby boomers had checked out. They left the labor force. Of course, the borders were closed. And I remember, I was doing a lot of flying back to L.A. at the time because I was hiding in Santa Barbara because the office was closed. And it's like the counter at JetBlue in Boston was like they just did not have enough people. People were coming back. Like everyone was like, okay, we're back, but the supply chains weren't there, and so we had this very tight labor market that, of course, we would hear about all the time. From the Jolts report. 2 job openings for every job seeker, that sort of thing. And that has been worked off over the last few years. I think that was the goal of the tightening policy, or part of the goal. So when you look at the Jolts report, or you look at the U3 jobless rate relative to NAIRU, the non-accelerating rate of employment, everything is in balance. Like it's right at that zero line. So the supply...
Is that why we've kind of been hanging around 4.3, 4.2 in unemployment?
So no one's hiring, but not many people are looking for jobs.
And not a lot of people getting laid off.
No. And so there's balance, right? The job seekers versus the job providers. But you look at that chart over 50 years... and you can see that there's a pendulum swing of that business cycle. So we went from very tight to neutral. And, the inclination is to look at that. And it's like, well, every other time that's happened, the next phase is contraction.
Recession, yeah.
And I think that's what the bond market is saying. That's, I think, where the Fed's coming from now that they did the 25. They're looking at the jobs data. They're looking at the revision, right? The jobs report revision.
Big downward revision, almost a million jobs.
911,000 jobs. And they're like, okay, we should build in some cushion for that. And so I think that's generally the vibe. But other than that, we have a whole economics team that looks at the business cycle, and we're not really seeing a lot of red flags other than that yellow flag, if you will.
How closely does the market cycle track the business cycle? Because I've heard it said so many times, the market is not the economy and vice versa. And the old joke is the stock market has forecast 9 of the last 4 recessions. Yeah. How do you see that overlay?
There is, of course, a connection, right? If you look at GDP growth and inventories, it's less about that now than it was decades ago. The impact of monetary policy. But, the markets are not the economy. There is a reflection because if the economy grows, earnings are going to grow, and then the market's going to go up because price follows earnings. But there's a sentiment equation in the stock market that, of course, you don't have so much in the economic cycle, and you have the timing, right? So the market is always going to anticipate future changes. So
you have a chart showing markets bottom 8 months below profits.
Yeah. So that's
a huge lead time. 8 months.
So you can be 100% correct about the economic cycle and be 100% wrong about the market.
Late as can be.
Because if it's already been reflected,
Right.
and if it's already has even over-earned against that future signal, then you're buying yesterday's
You missed
news.
it, right.
But yeah, so the market generally at bottoms will bottom 2-3 quarters before earnings. That happened during COVID, and I remember it like it was yesterday, because during COVID, the market fell 35% February and March. Then, like late March, it bottomed, and
March 25th.
I think
that.
by June it was at new highs. And people,
Right. 69% for the year from the lows, which is amazing.
And people like The Economist had a cover saying this is divorced from reality. And everyone, and so it's my job, A, to have people not sell in the first place, to be the long-term investor. The way I always describe it is you're getting a really juicy 10-11% return by investing in stocks, but the price of admission is you got to endure some volatility.
Right.
And if you can't stand the price, then you don't get the reward.
How do you explain to clients, and I got a million calls, man, this market has become disconnected from reality. What's your explanation to them?
So that what happened? It happened after the financial crisis.
Right.
So price bottoms, the market bets on recovery, and it could be wrong, right? Price discovery doesn't mean the market knows everything, and that's one thing where I sometimes disagree with technicians who say market's always right. So well, the market's not always right, but the market's always right in discounting everything that's knowable.
Right.
So it's right in that, but it doesn't mean that what it's discounting can't change, right? And we saw this during the tariff tantrum in April. The market was pricing in a left tail that never arrived, and then it had to unprice it. So the market looks ahead, and the market bottomed in March of 2009. Earnings didn't bottom until the third or fourth quarter. Same thing during COVID. March bottomed in March of 2020. Earnings recovered third or fourth quarter, and so you can't look at the news and say how can the market be here when the earnings or like people are dying.
So how did you explain this to clients? I'm curious.
I explained it exactly that way, that the price always leads, and you can't look at it in sort of a linear way. You have to just you have to know that at inflection points, the price action is going to make no sense, and this is why people sell at bottoms and buy at tops, because they're trying to understand the narrative, and that narrative is not the one that is ruling the roost at the time.
One of the things that we found was useful was explaining to clients that their life experience isn't market cap weighted. When you look at what's driving the big indexes, back then it was the FANG, now we call it the Magnificent Seven, but we did a calculation and found out that if all the airlines, all the hotels, all the local retailers, like just a run of the worst businesses during the pandemic, if they just disappeared tomorrow, it was 6% of the S&P 500. And, or Apple or Microsoft. It's amazing how our daily experience is so different from what markets are like.
And we had that during Brexit in 2016. I mean, that was constantly the headlines. What about Brexit? Why is the U.S. market ignoring it? Well, because
it's irrelevant.
Because the U.K. is 3% of S&P revenues. That's why.
So that raises a really interesting question about the U.S. versus the rest of the world in terms of economic activities. So the S&P 500 gets just about half of its revenue from overseas. For most of the past 15 years, the U.S. side of consumer spending, business spending, government spending has been very supportive of the domestic side of the S&P 500. Kind of feels like that's shifting a little bit. We're seeing a little slowdown on consumer spending, a little slowdown on economic activity here, as Europe and Asia seem to be finding their footing after a bad 10 years. Can we just pass off the baton without the S&P stumbling? Is that possible?
It's possible, and it's actually happening right now. And this is one of the areas that I'm most excited about right now, is that this U.S. bull market has become a global bull market. You look at EM stocks, Chinese stocks, Europe, Japan, and it's very exciting because, for many years, right, the U.S. exceptionalism train has been running since 2014, 14, 15. And the rest of the world was always so tempting with its lower valuation. And I've had conversations with our asset allocation PMs for years saying, yeah, I can buy EFA or EM at 14
They're
times.
Cheap. Yeah.
Why?
It's cheap for a reason, though.
And it's cheap for a reason. The market's very efficient, but the catalyst. So you need a catalyst to make the mean reversion in valuation to trigger that, and the catalyst is always going to be related to earnings. Like if you look at the relative performance, U.S. versus non-U.S. over the past 10 years, it's exactly the same as the relative earnings line. Like it's the same thing. So you need something to change on the earnings side, and that's changing. So we have, of course, a very concentrated market in the U.S., and that does pose risks, right? I mean, if those 7 stocks go down, guess what? The S&P is going to go down, even if 70% of the stocks in the S&P are going up. If you're an indexer or you're buying an SPY, you're not going to feel those gains because those top 7 stocks are taking the index down. And so for the last year or so, it was a question of, okay, how do you diversify against concentration risk? Do you go down cap? Do you buy the Russell 2000? But now the answer is easier because now you have a catalyst, a fundamental catalyst that is causing the mean reversion to happen between U.S. and non-U.S. stocks. And where that's coming from is that, so I'm a big fan of the discounted cash flow model, the DCF, which looks at not so much earnings, but the payout of earnings. So if you have earnings growth at 10% and 70% of those earnings are being returned to shareholders as dividends or buybacks, the payout is that 70%, and the payout ratio is 70%. And for the U.S., it's always been a very dominating scenario where the payout in the U.S. was very strong because of all the share buybacks we have here.
Where are we today with that? Are we still seeing the same sort of share buybacks? Because it seems like we haven't been hearing a lot of announcements, but that doesn't mean it's not happening.
We don't hear a lot, but the buybacks are at record highs. $300 billion over the last 12 months, and the payout ratio is 75% for the S&P.
Wow.
But guess what? The payout for EFA, which is non-U.S. developed stocks, the payout ratio is also 75%. It always used to be lower because they don't do buybacks over there.
Right.
They do dividends, but now they're doing more buybacks. And the growth rate in the payout itself over the last 5 years is now higher in EFA than in the U.S.
Wow.
So you're getting equal or superior or at least competitive fundamentals at a fraction of the valuation. And that's a good deal. And so finally that part is working where the pond that we're fishing from is now broader. And for me, it's a barbell strategy. I don't want to be short the Mag 7 because they can get bigger,
right,
and you don't want to miss out on that. But rather than going down cap in the U.S.,
go overseas.
Do a barbell of Mag 7 and non-U.S. stocks. Then you can play the dollar with dollar weakening story. You can get equally good fundamentals for a 15 PE instead of a 24 PE. And to me, that's a good thing right now.
So the last 2 things I want to talk to you about in terms of the current environment are inflation and sentiment. And I'm not sure how much of this is related. You know, when we see the Michigan sentiment data, it seems to be so awful. And it just doesn't feel like, is this really worse than the financial crisis, worse than COVID, worse than the dot-com implosion in 9/11, or worse than the 87 crash? If you follow the sentiment data, it's saying yes, it just doesn't feel that way.
No, it doesn't. And I think the sentiment data, obviously they're very bifurcated by political belief.
Right.
You know, and
we've seen those charts are really useful.
Yeah, and I spent time on both coasts, and I was at a dinner party in Montecito, California, a few weeks ago, and people were like, "How can everything look so good when we're like at the end of the world type of thing?"
Right.
And then I'll be in some other place, and it'll be the total opposite. But I think a lot of the sentiment data are still driven by the inflation data. Like obviously the inflation rate has come down to 2.8%.
But everything remains more expensive.
That COVID spike, that has not been unwound. And that's one of the things I worry about because not to make a comparison to the 1970s, which obviously was the great
Structural
inflation.
and long term.
But during the 50s and 60s, inflation was super low, 2%. Then to the second half of the 60s, it started to creep up. And then it came back down. But in order for the average to be at 2%, if you go to 6%, you then need to go below 2 for the average to be 2. And we haven't done that. We went from 2 to 9 to 2.8.
Right.
And we never went below 2. And if we, for some reason, get another upswing and we're at 3 and 4, like that 5-year number is now going to be at 4 or 5%. And I think that's what's driving a lot of this. It certainly did during COVID. And it's things like food, right? So, like the top.
Now beef prices are up. Egg prices have come back down, but beef prices have run away.
So I think a lot of it has to do with that because, people are employed. Wages are competitive right now. And, unemployment rate's 4.3%. But I think it's just that cost of living, it just kind of like grinds, and it's been grinding for 5 years now.
So let's talk about that 2% target. In the 2010s, an era of concerns about deflation and monetary stimulus, 2% seemed like a reasonable number. Is that still a reasonable number now that, and that was an upside target, right? You were at 1% aiming for 2. Now we're at 2.5, 3, aiming back at 2. Maybe in an era of fiscal stimulus, 2.5, 3% makes more sense. I mean, I'm not a monetarist, but I don't know why the whole world changes except for our inflation target.
Yeah, there's nothing magical about 2. Like if you go back 150 years again, the average inflation rate is like 3%, 2.8. If you look at a distribution of equity PEs and the inflation rate, the sweet spot is sort of 1 to 4.
Right.
So whether you're at 3 or 2, like for the stock market, doesn't matter. Like 10 to 2, like that matters.
9 matters.
That matters. And that distribution is interesting because obviously the higher the inflation rate goes, the lower the PE, which makes perfect sense because if inflation goes up, bond yields go up, then the safe asset is very competitive with the risky asset, so why take the risk?
Plus the cost of capital goes up.
If you go to the left tail, deflation, there is really no correlation. Nobody likes deflation. So from that angle, 2.5 is not a problem. Even 3 is not a problem. I think the Fed worries that if they were to ever admit that, inflation expectations could get unanchored. But they went to the AIT thing, right? The average inflation targeting. And that actually prevented them from raising rates when they should have back in 2021 and 2.
They were late to the party to raise, and they seem like they were late to the party to cut as well.
So their policy was we need to see the whites in the eyes of inflation before we raise rates. And by the time the whites of the eyes were visible, it was like too late. Inflation was at 5 going to 9. But so, it's a nuanced thing. But again, 3% is not going to be the end of the world. It just means the bonds have a term premium, and the stock market is still fine. Maybe the PE is like 17 instead of 19. But if earnings are doing the heavy lifting, it doesn't matter. But again, it's like what will it take for the Fed to actually say that, or will they ever say it, or will we just have a post-Powell Fed that says, instead of neutral being inflation plus 100, neutral is inflation, and so they are at 3 instead of 4 or something.
So I see your charts everywhere. Not only are they all over social media, but you do regular chart packs. I love your monthly chart pack. I'm going to flip open my laptop and let's look at some of your favorite charts. And I'll make these available on YouTube and on the website when this posts. Let's start with market cycles. And what we see going back to around our birth date is just a series of long bull markets followed by shorter, shallower bear markets. Tell us about this market cycle chart and what are the different shading means in blue and red? What's the significance of that?
Yeah, so the shadings is the valuation, the 5-year CAPE ratio.
When it starts to get pricey, it turns red.
It turns red, yeah. And so what the top part of the chart shows are the market cycles. So the green are, the bull markets, of course, cyclical bull markets. The red are the bear markets. And you can see, as we talked about earlier, it's pretty rare for a 50% drawdown. There's only been really a couple of them. And so what this shows is that the current bull market, as strange as it or as unusual as it has felt for many people, actually is pretty garden variety, right? 88% gain over 35 months. So it's pretty average. But then when you look at the bottom panel, it shows the percentage of stocks outperforming the index. And now you see something pretty unusual, something we've only seen a few times in history. And that is, of course, the concentration effect of the Mag 7, then before that, the FANGs. And the market is as concentrated as it was in the late 90s and the early to mid 70s, which was the original Nifty 50 period. And so, for an indexer, I guess it doesn't matter. For an active investor, it does. But even for an indexer, it does, because the largest stocks are getting bid up, whether they deserve it or not. Of course, they're large because they deserve to be generally. But it shows you how narrow the market has been during this cycle. And so it's just a way of describing kind of where we are. So you got the cyclical on the top, and the bottom speaks more to the secular.
Really interesting. Let's go to debt dynamics, which is kind of interesting. Let's see how far down I have to go for this. Did I pass it already?
No, it's the next one.
There it is.
Yeah.
All right. So let's talk about debt dynamics, which shows the change in federal debt versus what?
So what this chart shows, and it's a very simple chart, but I think it speaks volumes, is that, during COVID, we kind of, I think, entered the fiscally dominant era where debt financing or deficit spending becomes a very major tool, which is definitely different from the financial crisis when we actually had austerity after the financial crisis with the Tea Party movement. Now we have the opposite. And in the initial years after that fiscal expansion started, the Fed was actually doing a lot of the heavy lifting by putting those bonds, or not those bonds, but putting bonds on its balance sheet. So you could see the rise in debt is largely accommodated by an expanding balance sheet. Since that time, since 2022, the Fed's gone into quantitative tightening mode where it's shrinking its balance sheet, but the debt just keeps going up. So the debt is now up about $14 trillion in the last 5 years, and only about 2.5 of that is sort of been absorbed by the Fed. So I put 2 and 2 together, and it's like, okay, if that purple line at the top just keeps going up, who's going to buy this, right? Who's going to buy the debt? And will the Fed be forced back into playing a bigger role in kind of mopping up that supply? And that's the fiscal dominance theme.
That's a little bit of modern monetary theory, is that the Fed can just buy up all the debt and there's no constraints whatsoever. SOMA stands for what?
System Open Market Account.
So that's what the Fed has on its balance sheet.
So that
went up since the financial crisis, and it's come down since 22.
It's the part of the Fed's balance sheet that is sort of the QE part, if you will.
All right, so let's talk a little bit about equity supply and demand. What are we looking at this chart back to 1986? Is this simply liquidity driven, or what's going on here?
So I think this is, and not a lot of people talk about this, but I think this is one of the fundamental drivers of the current secular bull market era. And so you can see on the chart, I started the clock at the bottom in 2009, which, again, I believe is the start of the secular bull market. And I look at just the supply and demand of equities just from within the corporate America structure. So not investor flows, but how much were there in IPOs and secondary issues? And it's a couple of trillion. How much was share buybacks and how much was M&A? And share buybacks and M&A have something in common in that it's corporates buying shares of other corporates, and those shares get retired, right? So that's the demand for shares. And what you see is if you look at the supply-demand ratio, like it's very unbalanced. Like it's the demand far exceeds the supply. And to me, this has been one of the important drivers for driving returns in the secular bull market. And there's no signs that this is letting up. And so when we think about what inning is the secular bull market in, when is it going to end, and why, this is one of the things I look at. It's just, when you're retiring far more shares than you're issuing, it's like, markets are going to go up, all else being equal.
What's so surprising about this is how relatively insignificant the retail flows are.
Yes, they are.
It's just the opposite of how so many people describe it.
Yeah.
Let's talk about U.S. fundamentals versus EFA fundamentals. So this looks at various market data, buybacks, dividends, etc. Tell us what this chart is showing us.
Yeah, so we were talking about earlier about there finally being a catalyst for non-U.S. stocks to compete with the Mag 7 driven U.S. stock market. And so on the left, I show the earnings line for the S&P, the payout, so that the share of earnings being returned, quote unquote, to shareholders.
Shareholder yield.
As dividends and buybacks. And then at the bottom, you see the payout ratio, again, either as dividends in the yellow, buybacks in the purple. And you can see the payout has risen very nicely, almost a double since 5 years ago. Payout ratio is about 75%. So very bullish fundamentals. Like those fundamentals deserve a high PE, right? Because not only are the earnings growing, but they're being returned to shareholders, which of course is worth more than if you're not getting them back. It's just the present value of future cash flows. But what's changed just in the last few years is that for EFA, again, which is the MSCI non-U.S. developed index, you see an even better growth rate in the payout, and you see
more than double.
Yeah, and you see an equally robust payout ratio, again, of about 75%. So the rest of the world is really competitive now, despite the fact that this is such a Mag 7 heavy market. And so this is, just a very exciting time, because you don't have to make that make or break binary decision. Like you're either in these big stocks or you're left behind. There are other places to get those returns now.
What's so fascinating about this chart is how inverted the ratio of buybacks to dividends is.
Very
in
much.
the U.S., 45% of shareholder yield is buybacks, 30% are dividends. That flips. In Europe, it's 47% are dividends, only 27% are buybacks, or I should say EFA, not just Europe, although a lot of it seems to be concentrated in Europe.
Yes.
How much of that is just driven by tax policy and regulations?
I think it's largely culture. It's just, and Europe is more of a value market, right? So it's really like the banks are really running the show right now. And so the U.S., it's more the growthy stocks. So they don't want to, so, dividends are kind of like a sacred contract, if you will. Like it takes a lot for dividends to be cut. So I think Europe and Japan has just generally been more of a value-driven, and the culture has been more, okay, we're going to earn so much and you're going to get that back as dividends. But especially the Japanese and also the Europeans are getting much more with the shareholder culture now in terms of unlocking value and returning those as buybacks. So they're starting to play the game.
Last few questions before we get to our favorite questions. You have a section in the chart book about the post 60-40 world. I've heard people say the old 60-40 is now 50-30-20 or 50-30-10-5-5. Tell us what you think of as the post 60-40 world.
So I look at it, I call it the 60-20-20. So the 60-40 paradigm worked like a charm, right, from the late 90s until the early 2020s. And 60% S&P, 40% Bloomberg Ag, so the investment grade bond index, and you got a 9% CAGR against the 9% vol. And what's not to like about that, right? During that time, inflation was 2.5%, so you got a very attractive real return with really moderate volatility. But the whole premise of that paradigm was that the 40 was insurance against the 60. So the 60, of course, is always the anchor. That's where the compounding is. And the 40 would be your port in the storm. I think that's now changed. So 2022 obviously was a return to the old Fed model days, where rising yields take the mojo out of the stock market, to put it mildly. The good news is that bonds, of course, now are a viable asset. They generate a positive real yield, but their correlation is now positive against equities instead of negative. So when I think about the post-60-40 world, I'm less worried about the 60. Like, we can add more international in the 60, and like we were just discussing. But what do we do about the 40 if the 40 can be the cause of problems rather than the solution to problems? And especially if we end up with a higher term premium, then bonds are not going to be as safe as they used to be. So then I get into kind of, okay, I'm going to take some share from the bonds. It doesn't have to be 20. Like, again, this is not investment advice, but back of the envelope stuff. And, maybe some cash strategies are more competitive if we're not going to go back to the zero interest rate days, which I don't think we are. Gold are the proven anti-bond over history, right? They don't produce a cash flow.
$3,700 as we speak.
But when bonds do poorly, gold really shines, no pun intended. And then you got to throw Bitcoin in there as kind of the wannabe exponential gold. And then other strategies like alternatives, right? Managed futures, equity long, short, private credit, all of those kind of alpha rather than beta strategies.
You have tips in there as well.
Yeah, tips, high yield, markets or asset classes that are not negatively correlated, but they're not positively correlated as well. So when you look at kind of the Sharpe ratios versus the correlation, not just to the 60, but especially to the 40, right? Because I want to hedge more against the 40 than the 60.
I was going to say, this doesn't look like a yield chase. This looks like a diversifier. Is that the thinking here?
Yeah. And actually, if you go down one chart, I think, right there.
Oh, look at that.
So I want high Sharpe ratios or high Sortino ratios, and assets that are uncorrelated. And you get into the BCom commodities, you get into gold. Bitcoin is not quite uncorrelated, but all the alt strategies are uncorrelated. And so, to me, that is sort of the next 60-40.
Really, really fascinating. Last question before we get to our favorites. You look at so many charts each week. You identify trends before a lot of people do. What are investors not talking about, but perhaps should be? What topics, assets, geographies, data points, what do you think is getting overlooked, but is really worth investors' time to pay attention to?
One asset class, and we just talked about it, that I think generally is seen as a sideshow. The way Bitcoin used to be, it's no longer a sideshow for sure, is actually gold. Because for...
Even at $3,700, it's... Well, are people still thinking of it as a sideshow?
I think institutions do, right? So regular retail investors, as I call them, you can buy GLD or some other gold ETF, and I own it in my portfolio. And so I think it's part of the conversation. But when you think about large endowments, institutional investors, even mutual funds, you need a special wrapper in your mutual fund to own physical gold. You need to go to the SEC and get approval. And so, gold has been sort of dormant for so long until recently that it's I don't really want to go through this trouble to buy something that doesn't have a cash flow, can't be valued, requires special regulatory approvals. And then all of a sudden it starts to run like it is now.
Everybody wants in.
And so I think that's the story. So ironically, because Bitcoin has obviously come well after gold as a kind of a store of value, hard money asset, in a way gold is kind of like where Bitcoin was 10 years ago or 5 years ago, where, okay, Bitcoin's interesting, but I don't understand it. I don't feel like spending 100 hours on this. It's a bubble. It's a scam. It's a pet rock. And gold is if it keeps going the way it is, and I suspect it will, the endowments are okay, people are asking me about this. I need to really figure out how do we, not how do we buy it. You can buy it, of course, but it's always been a dismissed asset. Let me put it that way. Among,
I mean, that's what I grew up with.
Yeah.
It was kind of mocked by the equity people. Depends on the length of the chart you look at. You could show a trailing multi-decade period where gold has outperformed the S&P.
Yeah, absolutely.
So if you look at gold as in a secular bull market, I'm not asking for a forecast, but what's within the range of possible numbers gold could run to from 3,700 up from the low 2000s and early, what are we peaking, like 2014 and then 2019, something like that?
And it was like 260 back in
I remember in the 90s. Sure.
Yeah.
When GLD first came out, I want to say gold was about 430, 440. I remember talking about it on TV and getting laughed at by anchors.
So I once saw a chart that actually Paul Tudor Jones created, speaking of Paul, where he compared the above ground value of gold or the value of above ground gold and compared it to the value of M2. And the chart
kind of track each other.
The chart concluded that when the money supply grows too fast, gold takes market share. So hard money takes market share from soft money, from fiat money. And at certain extremes, like in the 70s and other periods, the 30s, gold, the value of gold will go all the way up or beyond the value of M2. And so right now, M2 is about 23 trillion. Gold plus Bitcoin is also about 23 trillion. So in that sense, it's come a long way to take that market share. And now it's a question of, does M2 either globally or in the U.S. continue to grow at an above average pace? So the average pace is about 6% nominal, about 3% real. So I do think a lot of the gains are in already, but it will naturally overshoot as these cycles always do. So that's kind of how I would measure it. So if the money supply goes to 30 trillion, gold and Bitcoin could be 35 trillion, and obviously gold is a large part of that. Bitcoin is about 2 trillion, and then you convert that to a price. But that's kind of how I think about the valuation side.
Really fascinating. So I only have you for a limited amount of time. Let me jump to my favorite questions that I ask all of my guests, starting with, tell us about your mentors. Who helped shape your career?
Definitely Ned Johnson, because when I came in to Fidelity in '95, I'd been in New York for 10 years, didn't really have mentors, and so Fidelity has a very strong corporate culture, let's put it that way, and especially around the way we approach long-term investments. We're obviously a long-term investor, but so he was like the last person I spoke to before I got hired. And then in those formative years, I worked in the chart room, and I would spend hours per week with Ned. Like, he would just come down.
Really?
And
hours per week.
And we would just pore over charts. Like, we have these huge charts on the wall, floor to ceiling, like 40 foot wide, like a daily chart of whatever the Dow, S&P.
Manually by hand. Done by...
It would be computer generated, but then because we don't want to print a whole new 40-foot sheet every week,
you would just
fill it in by hand, and just the oral tradition, the oral history. So he was looking at the chart, and then he would say, okay, well, and he would go from right to left and say, okay, then, and we'd end up like in 1968, and he's telling me about the glamour stocks and this and that. And I'm like, wow, this is like gold, right? Like, you don't,
Literally.
And so he would have this encyclopedic memory, but also just the way the information was displayed, semi-log scales. The chart room has like museum quality lighting, how you display, how you visualize, data. And so that he instilled that culture, we call it Kaizen, kind of just gradually improving. And having, compounding isn't just for investing, right? It's just in our day-to-day stuff. You do something consistently right, it's going to make an impact. And when I look back at my 40 years, and I'm not going anywhere, but like, to me, that Kaizen has really played a role in my relationships, in my work, and I think a lot of that just came from him. Really
interesting. Let's talk about books. What are some of your favorites? What are you reading now?
So I hate to admit it, but I don't read a lot of finance books because I'm very interested in having balance between.
Oh, I don't want finance books.
Between right and left brain.
We've all read Reminiscence of a Stock Operator. I'm more curious as to what else you're reading.
Well, I will say that during COVID, I read this huge tome called The History of the Federal Reserve by Alan Meltzer.
Oh, sure.
Because, I've looked at so many charts. You've read the reports of, financial
it's like
repression.
1,000 pages, isn't
financial
it? It's a
repression,
doorstop.
But I went, that book, it was like this blow by blow using the Fed minutes and all these, correspondence to see how the Fed handled the financial repression of the 40s. And so that was fascinating, although most people would say, well, that sounds really boring.
A little dry.
But as a consumer of the data, just to see, okay, whoever was at the Fed would go to the Treasury and they were playing games, like the Treasury would issue bonds below market and then the auction would fill, and then knowing that the Fed would have to mop up the supply, all of that stuff was just really fascinating. And and we see the interference in with politics and monetary policy today. But it's nothing new. Like in the 60s, both Nixon and Kennedy were equally guilty of...
Seems a little more overt and public today.
Overt,
it used to be sort of cloakroom sort of stuff.
Yes. So that was one. But the most interesting recent book I've read was, it's called Rock Me on the Water. And it's a book about music, TV, and movies during the early 70s and how L.A. was like the epicenter of American culture. Mm-hmm. So you had the Laurel Canyon folks, of all the musicians.
Joni Mitchell, David Crosby.
And you had these groundbreaking TV shows, right? Because we were coming out of the straitjacket of the 60s conformists. No one dared to make a show that challenged the status quo. And then you had MASH and Mary Tyler Moore, All in the Family, and then the movies like Taxi Driver. And as I think I'm kind of Gen X, but on the border of Gen X and baby boom.
I'm in the same, a foot in each camp.
Yeah, and so growing up, formative years in the 70s in Aruba, but consuming American pop culture. Right? We would sit down every night watching Wide World of Sports and Mary Tyler Moore and all those shows.
Rock Me on the Water.
Rock Me on the Water. And it's just so. It's fascinating to read about the things that we lived through as kids, as teenagers, but then that was so. Amazing.
Let's talk about streaming. What are you watching or listening to right now?
We are binge watching The Bear. So I'm an avid cook. Like I said, I run a food camp at Burning Man. And and we tend to be late to shows, and then we just watch four seasons.
Yeah, The Bear is great.
Yeah, so
and if you're a cook or worked in restaurants, it just rings so true.
Yeah.
I got to ask you a crazy question. You're a cook. What pots do you like? What knives do you like?
I use the all-clad. I have two places. I have a gas stove in Santa Barbara and an induction stove in Boston.
I came this close to putting an induction stove in my primary residence, but we had just gotten gas, and so, of course, we ran with gas.
Yeah, I will run with gas anytime. Mm-hmm. Induction is good. It's very precise.
Yes.
But I like the organic kind of tactile dimension of gas, but so all clad, and the German knives, what's it called, Gusdorf, I forget. And my go-to knife is a 10-inch chef's knife, not the really high one, but the medium one. So the medium one is thick enough to smash on garlic, but not so thick that you don't feel connected. You don't have the road feel of the knife on the cutting board. So my guilty pleasure on TikTok is little food clips. And I don't even have to have the sound on. It's just, because I kind of know what works with recipes, so I don't need a recipe, but I just need someone to visualize an approach. And so a lot of the things I cook today are from TikTok.
Oh, no kidding.
Yeah.
Oh, that's amazing. All right, our final two questions. What sort of advice would you give a recent college grad interested in a career in technical analysis, fixed income, or just investing generally?
Be open-minded, be humble. The true heroes of mine in our business, including Ned Johnson, he's no longer with us, of course, was that just humility, right? I'll talk to Will Danoff, who runs $300 billion.
I love Will.
He's the humblest guy
Right. He's amazing.
you'll ever meet. And there's no room for big egos, like no matter how important you are. Like I have no time for that, right? So stay humble. Don't think you've figured it all out when at the age of 25. Be a learner and be ready to reinvent yourself. I've had to do it a number of times at Fidelity, either as planned or as not planned, and you just gotta roll with the punches. And like I said, the first job I had, I was like the last job I was interested in, but I took it because it was the only job.
And our final question: what do you know about the world of investing today you wish you knew 40 years ago or so when you were first getting started?
That markets go through cycles, and it always comes back, not always quickly. But, every time the market goes down 20+%, it's like the end of the world. And it's like totally different from every other time. And this is like such a crisis. But then, I've now been through like 12 bear markets in my career, and it's like, yeah, whatever. Like nothing shocks me anymore. Of course, I'm maybe in a better place because I've earned my wealth. I'm not still building it, but
Right.
but it's just take a step back, look at the bigger picture, make sure your portfolio is where it should be in terms of risk and goals. And don't be your own worst enemy by selling at the bottom. Call someone, like have them talk you off the ledge first.
Jurrien, thank you for being so generous with your time. This has been just delightful. We have been speaking with Jurrien Timmer. He is the Director of Global Macro at Fidelity. If you enjoy this conversation, well, be sure and check out any of the 560 we've done over the past 11 years. You can find those on YouTube, Spotify, Bloomberg, Apple Podcasts, or wherever you get your favorite podcasts. Be sure and check out my new book, How Not to Invest: The Ideas, Numbers, and Behavior That Destroy Wealth and How to Avoid Them. I would be remiss if I did not thank the crack team that helps me put these conversations together each week. Alexis Noriega and Anna Luke are my producers. Sean Russo is my researcher. Sage Bauman is the head of podcasts here at Bloomberg. I'm Barry Ritholtz. You've been listening to Masters in Business on Bloomberg Radio.